The 50-year mortgage. Oh my gosh. It's so crazy what everyone is saying about this thing. And it's interesting because it is the most money-making machine for the banks that you could ever find out there. I don't think this is going to become a reality. There's more benefit to buyers using an adjustable rate mortgage, which is a common program used in today's market now. And we're going to take a look at some numbers here for you to see what that really can mean for you. I'm Anthony Carr, if we haven't met before. I'm a broker for over 30 years in the Washington, D.C. area, Maryland, D.C., and Virginia. And today the topic is the 50-year mortgage. What does that really mean for you if you decide you want to go that route? Time will tell. A few things about mortgages and the numbers that I'm using on this video. The median house price in our area is $715,000. The average down payment in our area is 15%. So the average mortgage is standing at $607,000 and change. And then this is the thing about why this is not getting me all upset about they're going to be in the house for 50 years. They're going to pay so much in interest payments and they're going to build up any kind of equity, because the average time that people are in a home is about 12 years. So we're really talking about the amortization effect and what that means for people that are getting a loan and what that does to their payment if they go for 50 years. Now, number one, I don't think it's going to happen. Okay. I don't think you're going to have a 50-year mortgage because there's too many other products that are available. But when you look at what it would mean on the amount I was just telling you about at $607,000, the 50 years, the top bar, and that is showing you that the payment with 50 years would be $3,307. Now, in our area, we've hit the $3,900 monthly payment mark for properties that are going under contract now. This would be a substantial drop in what people would pay because they're elongating the time that they're going to be paying that off, even though they're not going to stay there for 50 years. It's just amortized over that time period. Whereas if they got a 30-year note, as you can see, it's about $430 difference on that. So obviously that is a really big difference, almost $5,000 a year. Now, the adjustable rate I was telling you about, the orange bar here, currently they're standing at 5%. Now, that means you stay adjustable for, you're staying at 5% for 5 years, and then it's going to adjust in year number 6 or year number 8, depending on when yours kicks in. But if you're going to get into the property and not stay there very long, this might be an option. And you can see that's even less than the 50-year amortized note that everyone's getting excited about. So you would have almost a $500 difference from a 30-year fixed rate to a 30-year adjustable rate. Some people can go for a 15-year mortgage. Obviously, that payment's going to be a lot more for the average price home in our area, but I wanted to put it out there so you see what that means. The difference in the money pricing is almost a full percentage, from 6.24 to 5.49. So that's the difference you would see if you were looking at a 15-year note. Now, what does this mean as far as the equity that it might build up? And that's where it really comes up with, what does this mean for you personally, financially over time? The monthly payment, obviously, you can now get into a property you would not be able to get into earlier if you had elongated this thing 50 years. But let's start on the right side here. In 10 years of that 50-year note, you would have paid your principal down $3,200. In the time period of 10 years, you would have also paid $36,000 to the bank for interest payments over that 10-year period. It's like 120 payments. They've gotten $36,000 from you on interest. On the 30-year note, it's a lot better as far as your equity is concerned. You've built an equity of $12,557, and you've only paid the bank $32,298. And then the adjustable rate in the middle here, roughly the middle, you've paid principal of $14,107, and you paid the interest of $25,000. And then, of course, the 15-year note, if you can swing that payment for the same type of house price, you've paid a lot down on your note. Now, the value of real estate is not just what you're paying down of what you owe, which is the orange bar. You're also gaining access to the inflationary benefit that you would have when your house is going up in value. The average amount that people experience in this property value going up is about 4 to 5% per year. If you bought that house for $700,000 in the next year at 5%, your home is now worth another $35,000. Plus you've paid down the principal. You're gaining equity by what you're paying down and by what the asset is growing. That's the difference here we're talking about. Yes, your monthly payment would go down. Let's go back to that one there real quick. Your monthly payment would be lower in the 50-year note. I would advise my clients, look, if you're just looking for a lower note, let's take a look at the adjustable rates, because you can have an adjustable rate. It's a 525 or a 723 or a 1020 where it sticks there for 10 years and then adjusts after that period of time. That might be really the way you want to take a look at lowering your payment instead of thinking about, let me go with the 50-year note. Because the problem with that is, you see, in 10 years, you've only paid down your principal by $3,200. And that's not leaving you a lot of money to work with on your next purchase. I think that's the last slide I have. Yes, the 50-year mortgage, is it truth or is it fiction? I think it's fiction at this point. But if you got any more questions about it, put them in the comments below. I'll get back to you on that. Thanks so much for coming by and have a great day.